In the financing section, we're going to look at changes that relate to my owners and creditors. When money comes in or goes out from owners or creditors, it's going to go in the financing section. The specific accounts we're going to look at will be notes payable, long-term liabilities, and my stockholders' equity accounts. Let's think about a liability like notes payable. What makes notes payable go up? When I do what? When I borrow more money. When I borrow more money, what's going to happen? Cash is going to come in. What makes notes payable go down? When I pay it off. When I pay it off, what's going to happen to cash? It's going to go out. Common or preferred stock in PSC. What makes my common stock account go up? When I do what? When I issue more shares of stock. And what's going to happen to my cash in that case? It's going to come in. I'm going to add it. And we haven't made common or preferred stock account go down, so we don't have to worry about that. We're just concerned about making it go up. Treasury stock. Remember, treasury stock is when I buy back stock in my own company. What would make my treasury stock account balance increase? When I bought back more stock. Okay, if I bought back more stock, what happens to my cash? It's going to go out. I'm going to subtract that. And what would make treasury stock go down? Well, I can turn around and reissue that stock that I bought back. So if I reissue some of it, then my treasury stock account would go down and cash would be coming in. Retained earnings. What makes retained earnings go up? This takes us back to chapter 1, doesn't it? Net income, good. What makes it go down? Net loss. And what else? Dividends. Dividends declared, not necessarily paid, but dividends declared. Do any of those impact us here? Not really. Net income or net loss is the starting point for my operating section. Not really going to impact us here, but we are going to think about it. We are, and we'll see kind of at the end how we'll analyze that account still. Dividends declared makes retained earnings go down. But what we need to know is how much dividends we have paid. That's what's going to impact cash. Let's think about dividends payable. What makes my cash dividends payable account go up? When I declare the dividend. When I declare the dividend, I have more cash dividends payable. Good. Does that in and of itself impact cash, declaring the dividend? No. What makes cash dividends payable go down? When I pay the dividend, does that impact cash? Well, yes, it does. Yes, it does. That's the figure we're going to have to get out then, is how much cash we paid for dividends. I'm going to do the mock journal entry just like last time. Again, strictly optional. It's a tool to help you. But now we're going to record the change in the equity account or in that long-term liability account, be it notes payable, bonds payable, common stock, and so forth, using the normal debit and credit rules. If we have any related accounts, we'll pick those up also. And then step 3 still is plug cash, whatever it takes to make it balance. It is our whole purpose for doing this. If we find ourselves plugging a debit to cash, that means cash comes in. We're going to add that. If we find ourselves plugging a credit to cash, that means cash is going out. We're going to subtract. Common stock began at 4, ended at 6. Let's stop right there. My common stock account went up. What must have happened? I must have issued more stock. What's going to happen to cash when I issue more stock? It's going to go up. Cash is going to come in. Now, this takes us back to chapter 11. Remember how I told you this one chapter kind of pulled together stuff from the entire course? All right, so now we're going back to chapter 11. Remember, whenever we issue stock, we credit the stock account, but for what amount? The par value or the stated value. Very good. Normally, hopefully, we get more for it than the par value or the stated value. The extra credit goes where? PIC in excess of par. How much cash do we get for issuing stock? Total increase in common stock and PIC in excess of par. So what must have happened? We must have issued more stock. That would make my common stock account go up. It also would make my PIC in excess of par go up. I'm going to do a journal entry. You might not need to. Okay. During the period, common stock went up, what, $2,000? What type of an account is common stock? Capital or equity. Very good. All right. Capital or equity goes up how? With a credit. So common stock is going to be a credit then. If you want to go on down to your journal entry, skip the first line, please. Skip the first line. And the second line can be a credit then to common stock. $2,000. But what's important is I didn't just get $2,000 cash for issuing that common stock. We need to also take into consideration any change in paid-in capital in excess of par. So during the period, PIC in excess of par also went up, in this case by $3,000. PIC in excess of par is what type of an account? PIC, paid-in capital, capital or equity, good. It's going up. Capital or equity goes up how? With a credit. Good. All right, let's go down to my journal entry, and that will be a second credit now. So we're going to skip the first line for the debit. We're going to credit common stock for $2,000, credit PIC in excess of par for $3,000, To make that entry balance, I would need to debit cash for how much? $5,000. So how much cash did I get for issuing common stock? $5,000. So I issued stock and I got $5,000 for it. Notice we don't show the 2 and the 3 separate. We simply got $5,000 cash for issuing common stock. What section of the statement of cash flows would that go in when I issue common stock? Financing. Good. Inflow or outflow? Inflow. Remember, the financing section is when money comes in or goes out from 2 groups, owners and creditors. This is a case where money's coming in then from my owners. I let Bootstrap Bill have a company to sell beauty products. I thought he might be in need of some of those. Dividends payable began at 9 and ended at 3. Dividends declared were $28,000. All right, I declared $28,000, but does that mean that I paid $28,000? No, we have to take into consideration the change then in my dividends payable also. During the period, dividends payable did what? It went down $6,000. The type of an account is dividends payable. Liability, making it go down. A liability goes down then with a debit. Our mock journal entry. All right, back to chapter 11. We declared the dividend. What account do we debit when we declare a cash dividend? Cash dividends declared. It doesn't matter which one you put first. Cash dividends payable, the liability goes down with the debit. So that's one part of my journal entry. Cash dividends declared is always going to be a debit. What if cash dividends payable had increased during the period instead of decreased? Then it would be a credit in this entry instead. So we're going to debit cash dividends payable to make that liability go down. Debit cash dividends declared because that is the account we debit whenever we declare a dividend. Now, I don't care which order you put those in, of course. To make it balance, how much must we have paid out in cash? $34,000. Now, remember I told you on some of these I would maybe do a journal entry, maybe not, and others I would always do a journal entry. This is the one I'm going to strongly encourage you to every time make a journal entry, because I have found when students try to do this one in their head, they have about a 50-50 chance of getting it right. Half of them will tell me 34 and half of them will tell me 22. So I would do a journal entry on this one. So we paid $34,000 in dividend. What section of the statement of cash flows will that go? Operating, investing, and financing? It's going to go in financing. Will it be an inflow or an outflow? It's going to be an outflow. Financing section, money coming in or going out to owners or creditors. In this case, this is money going out to an owner. Bonds payable. All right, we briefly mentioned bonds before. Bonds are a way of borrowing money just like notes payable. The only difference is, remember with a note payable, if I borrow the money now, I don't make any periodic payments until the note matures, and then I pay all the principal and all the interest at one time. Bonds payable are a way of borrowing money, and the only difference is usually each 6 months I pay the interest. So every 6 months I pay the interest, but I don't pay any principal until the bonds mature, and then I pay back all of the principal at one time. So it's just another way of borrowing money. Bonds payable began at $690 and ended at $630. Let's stop right there. Tell me what must have happened for bonds payable to go from $690 down to $630. I must have paid off some bonds. Okay, that's going to be an outflow. However, then I throw that next sentence in just to muddy the water. $100,000 in bonds were paid off during the period. In addition to paying off the bonds, what else must have happened? We must have issued some new bonds, okay? Because my bonds payable would go down by the $100,000 when I paid it off. Well, it ended up with more than that. I must have issued some more. In the next section here, we're going to calculate how much must we have issued. The beginning balance in bonds payable was how much? $690. And we paid off how much? We paid off $100. So we would expect to end up with a balance of $590 in bonds payable. But we actually ended up with a balance of $630. How much more in bonds payable must I have issued? $40. So in other words, I borrowed an additional $40,000. Now this is the one, folks, where I would not do a journal entry. Just because we got the same account involved twice, I find that just confuses students. So I usually don't do a journal entry for this one. Let's think about how we're going to show these. Where are we going to put that on the statement of cash flows? How about the $100,000 first? We paid off $100,000 in bonds. What section will that go in? Operating, investing, or financing? Financing. Will that be an inflow or an outflow? That's going to be an outflow. The $40,000 from issuing new bonds would also go in the financing section as an inflow. So what I want you to see is that we don't net the two out. They were two completely separate transactions, and we would show them separately. So we would subtract $100,000 for paying off bonds we would add $40,000 from issuing new bonds. Don't lose sight of the fact that we're doing the statement of cash flows, and it all comes back to what impact did this have on cash? Did cash come in or go out because of this item? And here's Walmart's. Notice, what do we see? Some of these we can understand. Proceeds from issuing long-term debt. Notice those are all positive numbers. In other words, they borrowed money. Cash has come in. Here are the payment of long-term debt. Notice those are all negative numbers because cash has to go out to pay off debt. Dividends paid. Again, negative numbers because cash is going out when you pay a dividend. Purchase of common stock. That's when they bought back their own stock as Treasury. Again, negative numbers because cash goes